Tonight, something important is happening in the silver market. Not a rumor, not a conspiracy, not a trust me bro headline. It's a real signal visible in price action inventories. An institutional behavior, and it's flashing brighter than it has in years. Silver is pushing levels that traders haven't taken seriously for a long time. And while social media is arguing about charts and targets, the real story is unfolding quietly in the background in supply chains, in policy decisions, and in how large players are repositioning right now. This video is not financial advice. This is a market intelligence briefing, because when silver moves like this, it's rarely about hype. It's about stress. Let's start with the obvious question. Why now? Over the past few sessions, silver has surged alongside gold, outperforming many risk assets. This isn't happening in isolation. It's happening at the same time geopolitical risk is rising. Bond markets are unstable. And central banks are signaling a very different future than the one markets priced just a year ago. When uncertainty rises, capital looks for assets that don't rely on promises. Silver sits in a strange place. It's not just a precious metal. It's not just an industrial input. It's both. And that dual role is exactly why this moment matters. On one side, investors are reassessing risk. On the other, industry is quietly competing for physical supply. When those two forces collide, silver doesn't move smoothly. It jumps. But price alone doesn't tell the full story. Look beneath the surface, and you'll notice something more important: availability. Global silver inventories have been trending lower for years, not collapsing overnight, draining steadily. A little more demand than supply year after year. That kind of imbalance doesn't make headlines at first. It builds pressure silently until something breaks. And now, pressure is visible. Industrial demand hasn't slowed the way many forecasts. In fact, in several sectors, it has become more resilient. Technology infrastructure, electrification, data centers, and energy transition projects all require silver in forms that are not easily substituted. Once that metal is used, much of it is locked away for decades. It doesn't come back to the market quickly, and sometimes it doesn't come back at all. That matters when supply growth is limited. At the same time, silver mine supply has struggled to expand meaningfully. New projects face long permitting timelines, higher capital costs, and growing regulatory complexity. Existing mines are dealing with rising energy prices, labor costs, and compliance requirements. None of this creates an immediate collapse in production, but it does create rigidity. Supply becomes less flexible, less responsive, and slower to react when demand increases. Markets don't need an outright shortage to reprice a commodity. They only need confidence in surplus to disappear. And that confidence has been eroding. When inventories trend lower and future supply becomes harder to predict, price sensitivity increases. Small disruptions suddenly matter more. Delays that once would have been ignored now move markets. This is why silver behaves differently from many other assets. It doesn't gradually adjust to new conditions. It compresses. It builds pressure. And then it releases that pressure in sharp moves that catch most participants off guard. By the time the move looks obvious, it's usually well underway. What's notable about the current environment is that multiple signals are aligning. Physical premiums remain elevated in many regions. Futures markets are showing repositioning rather than complacency. Institutional interest is increasing, not because of excitement, but because of risk management. These are not emotional decisions. They are defensive ones. Silver is being reassessed not as a speculative trade, but as a strategic material with limited elasticity. That shift in perception is subtle, but it's critical. Once a commodity is viewed through the lens of availability rather than price alone, the framework changes. The question stops being, is it cheap? And becomes, will it be there when needed? This is also why comparisons to past cycles can be misleading. The market structure today is different. Global supply chains are more fragile. Inventory buffers are thinner. Demand is more specialized and less discretionary. And geopolitical considerations now influence commodities in ways they didn't a decade ago. Silver is not just responding to inflation expectations. It's responding to a world that is less predictable and less integrated than before. None of this guarantees higher prices tomorrow. Silver remains volatile, and pullbacks are always possible. But dismissing current signals as noise ignores how commodities actually behave under stress. They don't warn loudly. They tighten quietly. And right now, silver is tightening. This move is not about a single headline or a single country. It's about accumulated pressure finally becoming visible in price. It's about availability being questioned. And it's about market participants adjusting before those questions become unavoidable. That's the context for everything happening now. Not panic, not certainty, but stress. And when stress enters a market like silver, the next phase tends to arrive faster than most people expect. While supply is becoming less predictable, demand is doing the opposite, is becoming more stable, more structural, and harder to reduce. This is where the silver market begins to behave very differently from what most people expect. Because unlike many commodities, silver demand is no longer cyclical in the traditional sense. It is embedded. It is engineered into systems that modern economies cannot easily pause. Silver is used because it works, conducts electricity efficiently, resists corrosion, performs under conditions where alternatives fail or become uneconomical. In sectors like electronics, energy infrastructure, data processing, and advanced manufacturing, silver is not a luxury input. It is a functional one. Removing it often means redesigning entire systems, not just substituting materials. That kind of change doesn't happen quickly, especially when performance and reliability are at stake. For years, the assumption was that technology would reduce silver usage through efficiency gains. In some cases, that has happened on a per-unit basis. But those gains have been overwhelmed by scale. More devices, more infrastructure, more energy systems, more data centers. Even when individual components use slightly less silver, the total volume continues to grow. The math is simple. Efficiency helps, but expansion dominates. This creates a demand profile that does not respond easily to price. If silver becomes more expensive, a jewelry buyer might step back, an investor might wait. But an industrial user does not have that flexibility. Production schedules, delivery contracts, and regulatory requirements do not pause because a commodity moves higher. When silver is required, it is purchased regardless of short-term price fluctuations. This is why the physical market often tells the story before the paper market does. Futures contracts can be rolled, positions can be adjusted, exposure can be hedged. Physical demand is less flexible. It shows up in premiums, availability, and delivery timelines. When supply tightens, these indicators move first, often quietly, long before headlines catch up. Premiums, staying elevated, even during price pullbacks, are not a coincidence. They reflect stress at the margin. They reflect competition for real metal, not paper exposure. When buyers are willing to pay above spot to secure delivery, it signals that price alone is no longer the only consideration. Reliability becomes just as important. This is where the distinction between paper silver and physical silver becomes critical. Paper markets are designed for liquidity. They're efficient at transferring risk and expressing views. But they rely on the assumption that physical supply will be available when needed. When that assumption weakens, paper prices can adjust violently to reflect reality. Physical shortages do not announce themselves with alarms. They appear as delays, as longer lead times, as smaller allocations. It's conversations that begin with, "We can get it, but not all of it." These signals are easy to miss if you're only watching charts. But for those operating inside the supply chain, they matter immediately. Another factor often overlooked is that industrial demand is global. It does not depend on one economy or one region. Even if growth slows in one area, it often accelerates in another. This diversification makes demand more resilient. It also means that localized supply disruptions can have global effects, because the system has fewer excess buffers than it once did. At the same time, recycling is not a quick solution. While silver can be recycled, much of it is dispersed in small quantities across complex products. Recovering it is expensive, time-consuming, and often uneconomical at current prices. Recycling responds slowly, and usually only after sustained higher prices justify the effort. It cannot immediately fill gaps created by rising demand or constrained supply. All of this creates a market structure where stress builds asymmetrically. Supply responds slowly. Demand resists reduction. Inventories act as the buffer, and when that buffer thins, volatility increases. This is not unique to silver. but silver's relatively small market size amplifies the effect. Small shifts in flow can produce large moves in price. This is why silver rallies often feel sudden. They are not sudden in cause, they're sudden in expression. Pressure accumulates quietly, then surfaces all at once, when the system can no longer absorb it. Right now, that pressure is being felt most clearly in the physical market. And history shows that when physical stress persists, paper markets eventually follow. The question is not whether demand will slow tomorrow. The question is whether supply can respond fast enough to prevent tighter conditions from becoming the new normal. And that question leads directly to what comes next. When all these forces converge, silver stops being a prediction and starts being a measure of pressure. Not a crisis, not a guaranteed just friction between supply and demand. Extreme price targets like $50, $100, or $200 create noise. Markets don't move to satisfy narratives. They move to clear imbalances. Price rises until enough holders sell or enough users adjust behavior. The level cannot be predicted with certainty. What can be observed is behavior under stress. Supply is rigid. Demand is persistent. Inventories are thin. Moves accelerate. Volatility rises. Corrections are sharper, but so are recoveries. Silver tests patience. It moves later than expected, then faster than anticipated. That is why this phase matters more than individual numbers. It marks a transition in how the market is perceived. Right now, silver is being reevaluated not as a forgotten metal, not as a speculative trade, but as a strategic material at the intersection of finance, industry, and geopolitics. This does not promise higher prices tomorrow, but it changes how risk is priced. Markets move on pressure, friction, and expectation, not belief. The signals appear quietly in how buyers secure supply, producers plan output, and investors adjust positions. Timing is never precise. Compression, expansion, repricing, stabilization. Where silver ultimately settles depends on how supply responds, how demand evolves, and how global conditions unfold. No one can know that with certainty. What can be done is simple. Pay attention. Understand why markets move. Separate stress from hype. And recognize signals from noise. The most important market moves rarely announce themselves. They build quietly. And then, one day, everyone notices.